You don't actually want probability. You want certainty. You say you understand that trading is uncertain. You repeat it to yourself like a mantra. Any trade can fail. Losses are part of the process. I trade probabilities, not predictions. But emotionally, you resist it every single time. You look for confirmation. You look for agreement. You look for something, anything that tells you this trade will work. And every time the market refuses to give you that guarantee, you hesitate, you interfere, you collapse. Here is the truth that most trading education never addresses directly. The single greatest obstacle to consistent trading is not a lack of knowledge. It is the human need for certainty operating inside a structure that offers none. You are a certainty-seeking organism trying to perform inside a probability-based environment. That conflict between what your brain needs and what the market provides is the source of almost every mistake you have ever made. In this video, we're going to examine why the human need for certainty quietly sabotages trading performance, what is happening neurologically when uncertainty activates your system, and what the internal shift looks like that separates traders who thrive from traders who perpetually struggle. Let's go deep. Humans crave predictability. This is not a weakness. It is a survival mechanism. We feel safer when outcomes seem controlled. In most areas of life, that mechanism serves us well. Effort produces results. Preparation reduces risk. Study more, perform better. Work harder, earn more. Practice longer, improve faster. The relationship between input and output is generally reliable. Trading breaks that pattern completely. You can analyze with precision. You can wait patiently for the setup. You can execute perfectly. You can manage risk correctly and still lose. Not occasionally, regularly. That contradiction between doing everything right and still losing creates profound psychological friction. Because the brain is pattern-seeking, it looks for cause and effect. It expects that correct inputs produce correct outputs. When that expectation is violated repeatedly, the mind does not simply accept the violation, it tries to resolve it. And the way it resolves it is by searching for more control, more analysis, more indicators, more confirmation before entry, more information to reduce doubt, more certainty before action. But here is the fundamental misunderstanding at the center of that response. The market does not reward certainty. It rewards execution under uncertainty. The search for certainty does not improve performance. It delays it. It corrupts it. It creates a trader who is always one more confirmation away from entering, always one more piece of data away from committing, always waiting for a guarantee that will never arrive. And while that trader waits, the opportunity moves. Part 2. The neuroscience of uncertainty. Let's go inside the brain, because understanding what uncertainty does neurologically explains why this battle is so difficult to win through willpower alone. The brain has a region called the anterior cingulate cortex. Its primary function is error detection. It monitors the environment for unexpected outcomes. When reality does not match expectation, when something uncertain occurs, the anterior cingulate cortex fires. It signals the rest of the brain. Something is wrong. Pay attention. Adjust. In normal life, this is useful. It keeps you alert to threats. It helps you adapt to changing conditions. In trading, it becomes a liability. Because in trading,
Unexpected outcomes are not errors. They are the structure of the environment. Every candle that moves against your position triggers the anterior cingulate cortex. Every trade that hits its stop activates the error detection system. Every moment of uncertainty, and in trading there are thousands of them, registers as something to be resolved, something to be fixed, something to be eliminated. The second neurological layer is the intolerance of uncertainty itself. Research in clinical psychology has established that intolerance of uncertainty is one of the primary drivers of anxiety. When people cannot tolerate not knowing, they engage in compensatory behaviors, excessive checking, reassurance seeking, avoidance of situations where outcomes are unclear. Sound familiar? Checking the chart every 30 seconds, searching Twitter for analysts who agree with your position, avoiding trades that are technically valid because they feel uncertain. These are not random habits. They are anxiety responses to intolerance of uncertainty, and they degrade performance in a measurable, consistent way. There is also a third layer. The prefrontal cortex, the rational, planning part of the brain, performs best under conditions of moderate predictability. When uncertainty rises beyond a certain threshold, prefrontal function degrades, decision quality drops, patience shortens, risk assessment becomes distorted. The brain shifts from deliberate thinking to reactive thinking, from process to survival. This is why the same trader who follows rules perfectly on a calm, structured day can abandon those rules entirely on a volatile, unpredictable one. The rules did not change. The level of uncertainty changed, and the brain's response to that uncertainty changed everything else.
Part 3. The prediction trap. Many traders confuse analysis with certainty. They believe that if they analyze deeply enough, study long enough, understand the market well enough, they can eliminate doubt. But analysis does not remove uncertainty. It narrows probability. There is a critical difference between those two things, and most traders never fully make that distinction. Probability says, given these conditions, this outcome is more likely than not. Certainty says, this outcome will happen. Probability allows for loss. Certainty does not. When you trade with a probability mindset, loss is an expected outcome within a known range. It is not a surprise. It is not a failure. It is a data point. When you trade with certainty mindset, even unconsciously, loss feels like betrayal, like the market broke a promise, like something went wrong that should not have. And that feeling, that sense of betrayal, is what drives every reactive decision after a loss. The widened stop, the revenge trade, the abandoned system. All of it traces back to one unexamined belief. This trade should have worked. That word, should, is the fingerprint of certainty thinking. Replace it with might. This trade might work. It has a statistical basis. The conditions support it. But it might not. And if it does not, that is not a failure of analysis. It is the probability distribution expressing itself. That reframe sounds simple, but applied consistently, it changes your entire relationship with loss. Loss stops being something that happened to you. It becomes something that happened within the expected range of outcomes. And when loss is expected, truly expected, emotionally, not just intellectually, it no longer disrupts your execution. When uncertainty is present, The brain seeks comfort, and one of its most powerful comfort mechanisms is confirmation bias. After entering a trade, you look for evidence that supports your decision. You find the analyst who agrees with your direction. You zoom out to the time frame that shows your bias more clearly. You ignore the signals that contradict your position. This is not laziness. This is the brain managing discomfort. Because conflicting information creates cognitive dissonance, and cognitive dissonance is psychologically uncomfortable. So the brain filters. It prioritizes information that confirms the existing belief. It discounts information that challenges it. The result is a trader who is increasingly disconnected from what the market is actually doing, and increasingly connected to the narrative they have constructed about what the market should do. Let's walk through this in real time. You enter a long trade. Price moves sideways. You feel the first hint of uncertainty. You open Twitter. You find one account predicting higher prices. You feel relief. You go back to your chart. Price starts dropping. You zoom out to the weekly. On the weekly, the level looks supported. You feel relief again. Price continues dropping. You find another analyst. This one says it is a liquidity sweep. You hold. At no point in this sequence did you ask, what is the market actually telling me right now? Instead, you asked, what can I find that will make this okay? That is confirmation bias serving certainty addiction, and it is expensive. Because the market does not care what narrative you have constructed. It moves based on order flow, and order flow does not consult your bias.
Part 5. Lessons from Professional Traders. Some of the most important insights about uncertainty come from professionals who have operated through decades of market conditions that defied prediction. One principle shared consistently among experienced traders is this: the goal is not to know what the market will do. The goal is to know what you will do when the market does it. That distinction is everything. It removes the burden of prediction entirely. It places the entire focus on response, on execution, on process. The professional is not asking, will this trade work? The professional is asking, am I executing correctly within this uncertainty? Those are fundamentally different questions. One requires certainty to answer. The other requires only self-awareness. Another principle observed among traders who have managed risk professionally across multiple market cycles: uncertainty is not the enemy of trading. Uncertainty is the source of trading opportunity. If outcomes were certain, there would be no edge. If price always went where analysis predicted, everyone would be profitable. It is precisely because outcomes are uncertain, because other participants are wrong, because positions are unwound unexpectedly, because news disrupts narrative, that edges exist. The trader who accepts uncertainty does not just tolerate the environment. They understand that uncertainty is what makes their edge possible. That reframe, from uncertainty as threat to uncertainty as opportunity, is one of the most powerful shifts a trader can make. And a third principle, widely observed in professional trading environments: emotional acceptance of uncertainty must be built before the trade is placed, not during it, not after it, before. The moment of entry is too late to begin accepting that the trade might fail. By that point, the position is open, the stakes are real, and the brain is already in threat detection mode. Acceptance must be preloaded. It must be the state you enter the trade from, not a reaction to what happens next. 6. The cost of certainty seeking. Let's trace exactly what certainty seeking costs you in concrete behavioral terms. When you seek certainty before entering a trade, you overanalyze. You add indicators, you look for more confluence, you wait for one more confirmation, and frequently, by the time you are certain enough, the move is already partially complete. You enter late, your entry is at a disadvantaged level, your risk to reward has deteriorated. When you seek certainty while in a trade, you interfere, you move stops, you exit early to lock in profit before uncertainty can take it back, you cut winners that should have been held, you turn disciplined trades into emotional ones. When you seek certainty after a loss, you revenge trade, because the loss violated your expectation, and the urgency to restore certainty to prove that your analysis was right drives you back into the market before the next qualified setup arrives. When you seek certainty across a losing streak, you abandon your system entirely because the system has failed to produce certain outcomes, and the brain concludes that certainty must be found elsewhere, in a new strategy, a new approach, a new system that surely this time will work consistently. And so you reset, and the cycle begins again. Every one of these behaviors, overanalysis, early exits, revenge trading, system abandonment, is the same problem wearing a different face. Certainty addiction, the refusal to operate inside uncertainty without interference. Until that root is addressed, the behavior will continue regardless of what system you are trading.
Part 7. The internal shift. Let's talk about what accepting uncertainty actually looks like in practice. Because it is not a single moment of realization. It is a daily practice. Before you place a trade, pause. Ask yourself honestly, do I believe this trade will work? Or do I accept that this trade might work? That difference between belief and acceptance is the gap between certainty thinking and probability thinking. If the answer is belief, you are carrying attachment into the trade. Attachment to the outcome, attachment to being right, attachment to the narrative you have built around this setup. And attachment will distort every decision from entry to exit. If the answer is acceptance, genuine acceptance that this trade has a statistical basis but an uncertain outcome, you are carrying something different, neutrality. And neutrality is the foundation of clean execution. The practical internal statement before every trade is not, this is going to work. It is, this setup has edge, the outcome is uncertain. My job is to execute correctly and honor the exit regardless of what price does. That statement, internalized before entry, preloads acceptance. It tells the anterior cingulate cortex before price moves, uncertainty is expected here. Variation is normal here. Loss is possible here. And the brain, prepared for uncertainty rather than surprised by it, responds with less activation, less cortisol, less interference, more clean execution. This is not positive thinking. It is neurological preparation, and it works. Part 8. Practical tools for tolerating uncertainty. Let's make this concrete. The first tool is the uncertainty statement, written before each session in your trading journal. One sentence. Today I accept that every trade I place has an uncertain outcome. My edge exists over a series of trades, not in any single one. Loss is an expected part of that series. Reading this before the session primes the brain for what it will encounter. It is the difference between being ambushed by uncertainty and being prepared for it. The second tool is the outcome detachment review. After every trade, win or loss, ask, did I execute correctly? Not, did it work? Grade your performance on process adherence, not on profit and loss. Over time, this rewires the brain's reward system. It begins associating reward with correct execution rather than with profitable outcomes. And when correct execution becomes the reward, the need for certainty about outcomes diminishes. The third tool is the discomfort log. Every time you feel the urge to interfere with an open trade, to widen a stop, to exit early, to search for confirmation, write down exactly what you are feeling. Not the trade details, the emotion. I feel anxious because price is moving against me. I feel the urge to check Twitter because I am uncertain. I want to close this trade because not knowing the outcome is uncomfortable. Writing the discomfort externalizes it. It moves it from inside your nervous system to outside on the page. And externalized discomfort is easier to observe without acting on. The fourth tool is the post-session uncertainty audit. Each week, review your trades and ask, how many decisions were driven by genuine analysis?
How many were driven by the need to reduce uncertainty? That audit reveals your actual relationship with uncertainty, not the relationship you believe you have, the one that is showing up in your behavior. And behavior is the only honest measure.
The market will never offer guarantees. It never has. It never will. It will offer opportunity within randomness, structure within chaos, probability within uncertainty. And the traders who learn to operate inside that reality, without demanding that it be different, without fighting the fundamental structure of what markets are, those traders find something the certainty seekers never will: consistency. Not because every trade works, but because their execution is no longer dependent on the outcome. They enter trades they might lose, they hold positions that might reverse, they accept losses that might have been avoided, and they do all of it cleanly, without hesitation, without interference, without the psychological weight of needing to be right. That freedom, the freedom that comes from genuinely accepting uncertainty, is not given to you by the market. It is built through repetition of the correct response, through honoring exits when everything in you wants to hold, through taking valid setups when everything in you wants more confirmation, through sitting with discomfort without letting it drive your decisions, one trade at a time, one session at a time, until accepting uncertainty is not something you practice. It is simply who you are. Your growth as a trader begins with self-awareness. The rest follows. I'll see you in the next video. Until then, control your mind.